Welcome to the channel. Welcome to the TMP group. My name is Tom. Today is Monday. It's the 21st of February, 2022. I'd like to wish everyone a happy President's Day. We know the market's closed today. That means there's no activity going on here in the U.S. and the U.S. markets. And so I wanted to take some time and talk about a subject we've talked about before, and that's how we can ensure our portfolios and ensure our investments that we have without panic selling, without falling into the FUD out there, the fear, the uncertainty, and the doubt. And in a volatile market, we can make money, in my opinion, make enough money to keep up with the decline that we have in our primary holdings, our core stocks and securities, and ride out some of this negativity and volatility in the market if we are long. Of course, here at the TMP group, we are bullish. We are long-term holders, and we believe that the market over time will give us the generational wealth that we're looking for. So happy that you stopped in today. On your way in, if you do me a favor, hit the like button. It's going to help with the YouTube algorithm. It'll get this video out to more and more people. And if you're new to the channel, feel free to subscribe. Doesn't cost anything. Try to come on here Monday through Friday, and then once or twice over the weekend, and just give you an update on what the TMP group is doing collectively, what holdings I personally am buying, or trades that I'm making. Most of our moves are long-term holds, but we will trade to generate capital and cash in the market, so we can take advantage of the downturn or the dips, if you would, and we can average down our costs and hopefully over the long term build that generational wealth that we're looking for. So first I want to talk about 4 or 5 ETFs that we can get into right now as insurance plans for our portfolios, and then I want to talk about the stocks that we consider our money trees, or as I call them, the Great 8, and then some higher growth, higher risk plans, stocks. So before I do that, I almost forgot. I got to tell you that I'm not a financial advisor. No members of the TMP group are financial advisors. You should use this video purely for entertainment and educational purposes. And do your own homework, your own due diligence. We're going to try to provide you with a very thin layer of research and kind of the attitude that we're taking towards the market. And then it's up to you to do your homework and research and see what works for you. Okay, so let's jump in. So there's 4 major indices in the market. We've got the Dow, we've got the Russell, we have the Nasdaq, and we have the S&P 500. If you look at your portfolio, you will see a trend as to which stocks you typically hold or you invest in. And if you believe that there is a correction or more of a correction coming, and right now the market is hinging on 2 things. It's hinging obviously on the Fed decision of raising interest rates and curbing inflation, and then it's also hinging heavily right now upon the fear, the uncertainty, the doubt in the Ukraine-Russia conflict. And we are probably going to see, again, in my opinion, we're going to see some more red before we see green. Depending on what Russia does. Either way, the uncertainty that's out there will continue to drive the market down. So come Tuesday, we will be buying more insurance programs or more insurance plans. And these are the plans that I want you to take a look at. So if your portfolio is heavy in the Dow Industrial, the Dow 30, I want you to take a look at these 3 inverse ETFs. Now, an inverse ETF is inverse means that it's going opposite. So if you believe the Dow is going to rise by a point, then the inverse will decline by a point. However, if you believe that the Dow is going to decline, or the indice will decline, then the inverse will go up. So there's 3 of them. So the first one is the DOG. DOG spells out dog, and that is the pro shares short for the Dow. So if you believe that the Dow is going to go down, then the DOG would be a 1-to-1 ratio inverse on the Dow. The second one is the DXD. Now the DXD is a leveraged inverse ETF, and it's going to leverage the gains or the losses by 2 times in the Dow, and that is the pro shares ultra short. And then the third for the Dow is the SDOW. That's my preferred, SDOW. Why is it my preferred? Because that is 3 times leverage on the Dow. If I believe the Dow is going to drop and my stocks are heavy in the Dow, then I like the SDOW because it is a triple leverage and it will give me 3 times the return either way on the Dow. If the Dow goes down, then the SDOW goes up. Now, if the Dow goes up, the SDOW goes down. So be careful, especially when you're talking about leverages. The next is the Nasdaq. Nasdaq is probably the most popular among the TMP group, if not the second most popular to the S&P 500. But if I am looking at inverse on the Nasdaq, the first one that I'm going to look at is going to be the PSQ, which is the ProShare short for the Nasdaq. And that is a 1-to-1 position on inverse. The next one is an ultra short, which is the QID, and that is a 2 times leverage. Again, if we think the Nasdaq is going to move negatively or move to the downside, then we get 2 times leverage on an inverse on the QID. And then, of course, my favorite again is going to be the triple leverage, which is the Ultra Pro short SQQQ. So you can take a look at those 3 and take a look at your portfolio, see if the stocks which that are in the Nasdaq, if it matches up with your portfolio, and you can buy insurance plans by buying these inverse ETFs. Moving on to the next index, which is going to be the Russell, and ProShares short on the Russell is going to be the RWM. That's RWM. That is a 1-to-1. The 2 times leverage is the ultra short, and that is the TWM. And then the Ultra Pro for the Russell is the SRTY, which gives you the triple leverage inverse. There's 3 right there for you: the RWM, the TWM, and the SRTY. Okay, last but not least, and probably the biggest insurance plan that we will buy and trade right now for the TMP group, our main portfolio, which is at TD Ameritrade, will be in the Russell, and we do like in the S&P 500. And in the S&P 500, we can take a look at the SH, which gives us a 1-to-1. That's the ProShares short to the S&P 500. And the SH is a flat 1-to-1. So if we believe the S&P 500 is going to drop, then we believe that we know that the inverse, which is the SH, will go up on a 1-to-1 basis. If you're looking for leverage on the S&P 500, here's 2 of them to look at. The first one is the ultra short, which is the SDS, and that's a 2 times leverage. And then, of course, and I'll say it again, my favorite, which is the Ultra Pro short, giving me 3 times exposure to the market. On the short side, which would be the SPXU. Now, the SPXU, again, is a very volatile, not a long-term hold. It's only an insurance play. And when I'm looking at these insurance plays, I'm looking to either buy the shares equivalent to 1% of my portfolio or the holdings of my portfolio that fall in the different indexes, or I'm looking to buy options and buy call options on these inverse plays. I personally like the 414. I like the strike price to be at the money or 1 outside of the money. Again, that's just my opinion. Take it for what it's worth. But having these insurance plans in the past have worked. History does not always predict the future, but it does tend to rhyme. And if you're looking to, put an insurance policy in on your portfolio and make some cash, if the market does go down, these inverse ETFs will climb and the inverse calls will print. The last one, and actually it's not an index, but it does follow the Cathie Wood's ARK, is the SARK, and the SARK is a simple 1-to-1 inverse against the ARK. So if you have a lot of positions, high growth positions that you find are in tangent with Cathie Wood's ARK, then the SARK might be something to look at. All right, now again, those insurance plays are only to be put in if we believe that the market is going to downtrend more. The reason I like to use the 414 calls on the inverses is because I think that once we come out of the March Fed meeting, and once we know which way the conflict in Russia is going, whether it's an attack or it's negotiations are made, that the market then will have some certainty and things will start to pick up in April. So I like the 414 calls there. Okay, like I said, this is only meant for 1% of our portfolios. I take the value of my portfolio. If the value of your portfolio is $100,000, then $1,000 in each play. I like to put, when I'm buying calls, I like to buy calls 3 at a time. That way, as they print money, I can shave off 1/3, shave off 2/3, and be playing with the house's money towards the end of these trades. All right, what is the TMP group? Where are we bullish right now, and where do we see value in stocks? Of course, I'm going to jump into the grade 8, formerly the Super 7, but we did add an 8th, and the 8th that we added was Berkshire B, so BRKB. But we are still extremely bullish in these stocks, and that would include Apple, it would include Tesla, it would include Microsoft, it would include Nvidia, it would include Google, Amazon. I think I'm leaving one out. Facebook, yes, even at these levels, Facebook, Meta, we feel is a strong buy. We are not selling those stocks. We are holding on to them. But I do see a decline, and I'm probably going to hold off on buying any more until March, which is only about a week away. Now, if you're looking at your portfolio and you have some of these stocks, for example, let's say you own 100 shares in Tesla at an average value of $1,000, and we saw Tesla go down to $850, we just lost $15,000. Same thing with Nvidia, from 300 to 230, 100 shares worth, we lost $7,000. On Microsoft, if our average was $300 and it's trading now at $285, not too bad. 100 shares, we only lost $1,500. Facebook, big one. Each position worth 100 shares at $320 a piece, down to $205. That means we lost $11,500 per position. Overall, $35,000 down. Does that mean it's time to sell? Absolutely not, in my opinion. That means it's time to hold, because the rebound will be that much stronger once we get past this. So that is long-term, our long-term love, if you would. And then Berkshire B, that is that rounds off the grade 8. So we're very, very bullish on those. We will continue to hold, and those will be our long-term money trees that will create generational wealth. Now, in the short term, where are we bullish? What will we buy if we're not buying anything right away and we're waiting to see kind of which way the Fed goes in March? And I don't think it matters which way it goes. I think that the certainty of knowing where it's going to go, the market will adjust. But in the short term, we're very bullish on energy, and we're very bullish on financials. So a couple of ETFs to take a look at. Energy ETFs, of course, is going to be the XLE, and then the VDE, which is the Vanguard Energy ETF. I personally like the ERX because it gives me a 2-time leverage in energy. And with the Russia-Ukraine conflict, we're seeing energy prices going up. We're seeing the cost of oil going up. The cost of gasoline will go up. And the ERX 2 times leverage, in my opinion, is the way to trade the energy sector. How about the financials? Where do we look there? There's a couple of them here. The XLF will give us a nice, solid ETF if we believe financials and banks are going to do well with rising interest rate environment. I personally like the triple leverage, which is the FAS. FAS will give me a 3 times return. And I believe that with the interest rates and inflation that looms, that the banking and financial sector is due for a nice pop. Of course, this is a short term, just through the interest rate and inflation worries, and these are trades, not long-term holding. Last but not least are our high growth stocks. They come with a little bit higher risk, but a higher return. At these prices, we think they are a steal, and so it's good to dollar cost average. Members of the TMP group, myself personally, will dollar cost average into some of these lower priced mid-cap stocks, if you would. That would include NEO, DraftKings, SoFi, so NIO, DKNG, SoFi, SOFI, Of course, here in Arizona, we love Lucid, LCID, ChargePoint to emerge as the leader in the charging stations. And then you've heard me talk about this one before, which is the Polestar Gores Guggenheim reverse merger, GGPI. Those are, like I said, some higher growth, long-term crops. They're not money trees yet, but they are stocks that we believe in, that we can plant into our portfolio, companies that we can invest in that'll help us sleep well at night. Two more I want to throw at you that I almost forgot. PayPal is at levels right now that we have not seen in the past year, so we will continue to dollar cost average into PYPL. And I do believe that Disney, DIS, is the ultimate reopening stock, so we will be increasing our exposure and going overweight on Disney, DIS. All right, having the rest of the day, the market closed. Market will open tomorrow, Tuesday, the 22nd. I do have optimism that over long term, if we zoom out on our stocks, we will see uptrends in our high conviction plays. So my advice is simply do not give in to fear, uncertainty, and doubt. You haven't lost anything if you haven't sold it. Your positions are still the same. They're just valued less. And over time, they'll increase. Let's take NVIDIA, for example, trading at around 235. I see NVIDIA as NVDA as a $400 to $500 stock again, and then I look forward to it splitting, because I do believe that's what happened. So individually take a look at your stocks. Hopefully this helps out. If you're heavy in the Nasdaq, heavy in the Dow, heavy in the Russell, or heavy in S&P, take a look at some of those inverse plays. Like I said, you can either buy the shares of stock to offset the losses, or you can buy calls on the inverses. I hope everyone's having a fantastic President's Day. I do hope that you can continue to invest in the market with confidence and don't give in to the fear of the uncertainty and doubt. And I also hope to see you on the next video.